Good morning, good afternoon, and good evening, wherever you are. This is Merrill Chandler, your host of the Get Fundable podcast and your guide to the Get Fundable universe. In this episode, we're going to kind of expand the fundability target to include indexed universal life insurance policies. How are they fundable? Do they contribute to our fundability, or do they get in our way? And how do they work such that we can use them as part of our traffic cascades? How would you like to borrow money at 1%? I'll see you on the inside.
In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
All right, welcome back. In this episode, just like you heard in the introduction, this is can be a really complex matter. Universal life insurance policies, being your own bank, infinity banking. There's a lot going on, even in the words that I just came out of my mouth. So we're in this episode. If you can, this is an episode that if you can get to the Get Fundable podcast and watch the video, if you can get to YouTube, it's going to be super valuable to watch the diagrams that I do on my easel. If you can't, as always, I'm going to explain as clearly as I possibly can every single step that I'm taking. But I just want you guys to know that there's going to be a lot going on. We're talking about universal life policies, or leveraging universal life policies, and also indexed universal life policies. If we were to do a scatter chart, there's like 20 different variations on a theme. So we're going to go for the 1,000-foot view to the 100-foot view. And then you need to talk to your insurance people about the boots on the ground view. But I want you to, if you haven't considered these before, if you haven't seen what they do, how they affect your fundability, that's what today is all about, this episode. All right, so let's build us a diagram, and I'm making it look like a whatever you want to call it, a beaker or an open-ended box with the open at the top. Right? This open-ended box is the container of the insurance of the universal life or the indexed universal life policy. So that is our container for those of you who are watching. Now, there are two main facets to one of these indexed or universal life policies. The first facet is what we call the cash value. I'll go in descriptors in all of these. So about and then let's go to the top. At the top, we're going to call it the death benefit, right? The death benefit. So in traditional terms of buying insurance policies, if it were a different type of insurance, is a term life. And what the death benefit, let's say you're going to do $1 million, right? So let's put $1 million up here. $1 million. $1 million. So you buy insurance for your age, for your health, for, there's physicals involved, etc. But you buy a life insurance policy so that if you die, the beneficiary, or whoever you have made the beneficiary of this life insurance policy, gets the death benefit of $1 million. Now, some of these policies, again, there are many variations on it, but some of these have where it gets smaller and smaller the older you get, right? Some of them you can maintain the $1 million. So let's say it goes down to $100,000 at 70 years old, $50,000 at 80 years old, etc. Some of these insurance policies, by growing how much you pay every year, you can maintain the size of the death benefit. Again, ask your registered and licensed life insurance agent for details. What we want to be aware of is there's the cash value and then there's the death benefit. So let's say the cash value, we're going to be making every year. Let's say that we have a policy where every year we add $10,000 in insurance payments. Now you can make $2,000 a year, $5,000 a year, $30,000 a year. You can buy as much insurance premium as you wish. And interestingly enough, some people use their IUL or their universal life policy as their savings program. Instead of putting it in the bank, because you're only going to get in this marketplace 0.5%, 0.75%, many universal life will offer 4 to 5% interest on your money. So you're buying premium, but technically you're putting it into a savings account, which is the cash value of that insurance policy. So for every 10,000, let's say you do it times five times. So you got $50,000 premium. Now there's the cost, and then there's administration fees. By the way, this is where it becomes super lucrative for the insurance provider and the insurance contact, your salesperson, because they could be making $1,000 a year. They could be making $2,000 a year. You're paying their commissions for signing you up on this program. So, and there are some workarounds way beyond the scope of this. My daughter is a life insurance. It has her licenses, and so there's ways that you can split the premium costs or get a rebate from someone you know. Whole bunch of workarounds, but that's beyond the scope of today's podcast episode. So let's say that we have put in $50,000 in premiums. And that 50,000 turns out to be approximately 40,000 in actual cash value. So we're going to put 40,000 in cash value. You paid 10,000, 40 of it made it into the savings part, the cash value of the insurance program. Now, here's what's awesome. Instead of putting it into the bank, you're putting it into this cash value. So you're making 4 to 5% interest on this money from the markets. And there are options out there. There are options for these universal lives where you can, they call them indexed universal life because they're indexed to like the Dow or some money market funds or otherwise, but it never goes below zero. So even though it's indexed 3%, 4%, 5%, I've had clients tell me that they've gotten 7 and 8% on certain years, but it never goes below zero. So even if you if the markets fail miserably, you don't fail miserably. So, but it's never less than 0%, right? They don't charge you money for the market's going southbound, but you have to elect for that. That's the purpose of this episode, you guys, is to make sure we're asking our people the right questions, our insurance agents the right questions. But now that we have $40,000 in here, cash value of 40,000, I can now borrow against that cash value at what? Many of them I can borrow at 1%. 1%. And so I'm making a net 2, 3, 4 or more percent on my money. So now some people, and the whole point of this episode is to compare the process of an IUL against fundability. Well, some people say, oh yeah, well, if you can borrow your own money, that means you can become your own bank. And so the term's infinity banking. You can use this as a master sweep account. Check out our episode on master sweep accounts. You can use this right here as a master sweep account because you're literally borrowing your own money at 1%. Here's the challenge that we're up against. Some people say, well, buy a car with your cash value, because if you buy the car from yourself and you're only paying 1%, you're using this $40,000 to buy a $30,000 car. The cash value goes down to 10 grand, but you're literally paying it back at 1%. So you are saving money. That you can do that for your second or third or fourth car. You don't want to do it for your first car. Why, Fat Funding Hackers? Because the first car needs to be on your profile. You don't want to finance it here. You want a lender to finance it, so it ends up on your profile as that placeholder auto loan. You want a second car, a car for the kids, whatever else you're doing, sure, you can borrow your own money here. But if we're going to go for the highest yield on fundability, we want that placeholder automobile. All right. Now, here's the other thing. You can also, let's say that we keep going and we keep going and we keep going. So I'm going further up the container, and let's say that we have $200,000, because let's say we did a fix and flip. Let's say we sold a business. Let's say we got a huge tax, a $10,000 tax. Whatever it takes, you can literally, the way you get it into the insurance is you buy more premium. So you buy more insurance, and let's say that you had a huge win over a couple of years, whatever it is, and now your cash value is at 200 grand. So we went from 40 and we kept adding more every dime we got, everything we did, massive bonuses, fix and flip, sold a house, whatever it was, that cash value became 200 grand. Well, here's what's also amazing about most. Again, you got to check with your agent, but about most of these, let's say you got 200 grand now, you can now buy a rental property using that cash value at 1% interest, and so that 200 grand at 1%, you're now paying yourself back a very, very rich cash flow from the rentals on that $200,000 home. So let me restate that. Now, let's say you buy a rental for 200 grand. Let's say at 200 grand, you're making, that's a $2,000 a month rental income. $2,000 a month rental income, but you bought it using your 1% money that is in the cash value of your IUL. So now you're paying, what's 1% of 200,000? Yeah, you're making $2,000 a month, but it's charging you $2,000 a year for that loan. You're paying yourself back at $2,000 a year. That means you're literally bringing in 2,000 is 24,000, 2,000 a year. You're bringing in, you're cash flowing $22,000 a year off that property because you borrowed your own money from the cash value pool that is in your real estate, or that is in this insurance policy. Now, here's what's tricky. You got to make sure you talk to your agent about this. But if you do this right and you buy these, let's say these properties inside of your IUL, it's now owned by the IUL, and all the appreciation is tax-free and is not subject to capital gains. All the profits are tax-free. Now, let's pretend a year or two goes down the road. You bought this house. You did 2 years worth of rentals. You decided, oh, we got $100,000. Let's say 2021 comes and goes. And you're like, whoa, we just made 17% on this house. We just made $50,000. Let's dump this house. You sell this house. You get back your 250, but your 200, but you made $50,000 in profit. That goes in as profit and premium inside of your IUL. So now your cash value to borrow against is now 250,000, not 200. Everybody following me? This is, it's just a wealth creation container. And some of the ancient banks that have been around for years started out as family banks that started where they started lending money out into the world instead of amongst their own empire. And hence the JP Morgans and the Chases, etc., use these models. Their progenitors use these models to lend to themselves, and it extended into becoming vast banking machines in the world. So this is the essence. Again, you have to talk to your investment advisor and or insurance agent, or both of them on a conference call. But the idea is to get your cash value as high as possible so you can borrow against it, expand your empires. I know people who, HVA people, home investor people, who are using their cash value life insurance to actually buy additional franchises. And some have sold those franchises for a profit, and it added a higher cash value in their insurance policy. And some of them, they've appreciated, and those franchises have appreciated in value inside of their life insurance policy. So think of it this way. Technically, it's life insurance because it has a death benefit, but it is a way more sophisticated machine, wealth-generating machine, if used above and beyond the death benefit. Now, there are some, you have to look for them, but there are some who allow you to borrow against a certain amount of the death benefit as well, not just the cash value. They may allow you to, based on how long you've had it, how long you've been with them, and how well you manage it. Just like any lender out there, these insurance companies who also own banks and who also lend to people, they may allow you to go above and beyond the cash value amount and creep closer and closer towards the death benefit amount, so that you are able to use that money now and build an empire to pass along that exceeds the death benefit of the life insurance policy. Because now you have, let's say you have a $3 million estate that's a cash value amount, and your beneficiaries upon your death, based on, after all the dust settles, all is said and done, that cash value then is part of what is passed along to your beneficiaries, your family, your loved ones, or whoever happens to be on that bottom line. So your IUL in 15 minutes. Glad you could join us. Catch us. Our podcasts are designed to share the fundability possibilities, not just explain this, but how I want to wrap this up, you guys, is that fundability is simply meeting the lender's funding guidelines, the approval guidelines, right? So those approval guidelines are very important, and there are approval guidelines inside of whatever IUL or universal life or life insurance policy that you decide to engage. So we want to make sure that we hit those guidelines, because that's how it creeps up towards, think of approvals here, letting you borrow against more than your cash value. This is Merrill Chandler, your guide to the fundability universe.
Thank you for listening to the Get Fundable podcast. Please leave comments because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you gotta tell your friends about this podcast because we want them to get fundable too.